Welcome to the webinar. You are in the right place. My name is Kiana and we are going to have a webinar about New Zealand dollar and its trading strategies. Before we start, I am using a new microphone. So can you please go ahead and tell me if there is a lot of noise or something, or if there is something, a problem with my microphone. So we do still have 5 minutes, so I can go ahead. Okay, all is good. Great. Thank you, Chris. All right, so we will be back in about 5 minutes, right in time to start the webinar and allow more people to join us for the webinar. I'll see you in a bit. All right, it is 12 p.m. here in New York, and I have Abdul, Anant, Arnold, Calvin, Chris, Mohammed, Rayed, and Thoko. All right, Melissa, Margaret, and everybody who are joining us, welcome. My name is Kiana. We are going to have a webinar. You're in the right place. Hi, Piet. You're in the right place. We're going to have a webinar about New Zealand dollar trading strategies. And my name is Kiana Danial. I'm the CEO of Investiva. And here we go. So before we start, I do want to let you know about high risk investments, and that the fact that trading a margin is probably not a good idea because it can result in losses that may exceed your deposit funds. So before deciding to trade Forex, if you're here to learn, that's great. We're going to share a ton of trading strategies, but before you actually get in and trade, definitely consider your investment objectives, your level of experience, your risk appetite, and your risk tolerance. Because at the end of the day, your goal and our goal is to grow our wealth and not lose it all. All right, everybody with me? Awesome. All right. Hi, Stella. Okay. So in today's agenda, we are going to first take an overview, an overlook on New Zealand economy. And then we're going to also a little bit touch on global outlook, especially the U.S., because it's the topic of the day every day. So we're going to touch on that a little bit and talk about how current U.S. politics may impact the Kiwi crosses. And well, of course, with U.S. dollar, if you're trading the Kiwi versus the U.S. dollar, you should know what's going on in the US as well. Then we're going to take a brief view on market sentiment, what's going on with Kiwi traders, how they are viewing the markets, and then we're going to do technical analysis, live technical analysis, and come up with trading strategies to see, to see if there are any trading strategies, if there is anything worthy of trading or looking into at the moment. So we're going to put them all together. This is a system that I call the IDDA approach. We're going to do it today for the Kiwi clauses. All right. So is everybody ready? Okay, I'm getting a lot of yeses. That's awesome. At the end, by the way, we're going to do a Q&A, but feel free to ask your questions during the webinar as well. All right, I'm getting all the yeses. Yes, ready. Let's go. Okay, so I'm taking a look at the New Zealand economy. If we don't go, I want to actually today, instead of going and looking at the economic calendar and see before doing that, I want to take a look at New Zealand economy as a whole and its overall long-term prospects. So for example, one of the headlines about New Zealand economy is fintech. And you know how, well, to grow and boost an economy, you need a lot of aspects, a lot of things to go hand in hand. And up until now, nobody really thought of New Zealand of being in the fintech industry. I mean, you want when you think about New Zealand, you think of Lord of the Rings, and then you think about farms and beautiful ski slopes, right? So it turns out that a tech leader and software company director has said that the setup of a national fintech organization will push New Zealand's economic growth, which is something that eventually could also boost its currency, right? A better economy normally, I mean, obviously there are so many things going hand in hand, but just looking at how, what the direction of New Zealand, it kind of looks like, at least like from the fintech point of view, the fintech community is growing, which in turn will contribute to New Zealand's economic growth. And as one other thing that is interesting, do we have any Bitcoin traders? I'm not a Bitcoin trader myself, but turns out that one of the setbacks in New Zealand has been in the Bitcoin exchange. So, and it was forced to shut down. So if you're trading Bitcoin, don't do it in New Zealand. All right, just wanted to throw it out there. But in other areas, New Zealand is doing relatively well, or it's expanding its fintech arm. Another thing that is adding value to New Zealand economy is tourism, which is interesting because we'll get into another country very soon, another country's tourism. You probably already know which country I'm talking about that is going downside, especially in the past month. But New Zealand tourism looks to be expanding, and tourism spending over the summer high season, right now, by the way, it's summer in New Zealand. It's the land down under. It's like Australia, right? So it's summer in New Zealand, and it has grown to in most regions, providing jobs for regional New Zealand New Zealanders. And so that is also something that looks like to be positive for New Zealand economy in a long term as well, because more tourists will create more jobs, and more jobs will create a stronger economy, and a stronger economy will hopefully lead into a stronger currency. Especially tourism, I believe does have a direct impact with the currency, because the more desirable your country is and more people want to go to your country, well, that makes your country's currency that much more valuable, because people who are coming from, let's say, America or Japan or Middle East or London, wherever, coming to New Zealand, they are going to buy New Zealand dollar, and that will supply and demand, right? So that more than fintech, I would say, would have a direct impact on the Kiwi dollar. And another thing to mention about New Zealand, so both New Zealand dollar and Australian dollar, they're called commodity dollars, right? And or COMDOL, because both Australia and New Zealand depend on commodity exports, such as iron ore. Also, well, New Zealand has another thing, which is dairy products, which is a little bit different. So for economic growth, they depend on iron ore and other commodity exports. And there has been a rise on commodity index. It has been climbing ever higher since mid-November of 2016. So that is something that you want to keep in mind as well, because commodity prices have been rising for various reasons since mid-November. But with regards to base metals, the most cited drivers are infrastructure spending in China and optimism, and intense speculation over Trump's fiscal stimulus plans, which includes investing heavily in infrastructure other than the U.S., right? Other than if Trump wants to create a wall, he probably is going to need some iron ore, but China is trying to divert. So the recent rise in commodity prices has allowed us, New Zealand as well as Australia, to print back-to-back trade surpluses in November and December, which will likely help their economies to rebound from from their performances, especially from Q3. All right. So here's this was the third observation about what's going on and what is behind New Zealand economy. And then most recently, not most recently, about 2 weeks ago, we had the RBNZ rate statement, and it was not supposed to be a big deal. So this was an interesting one, right? It was not supposed to be a big deal because everybody expected that they're going to keep the rate steady, and they did. But at the time, Kiwi really sold out instead of going up, which is a very, well, typical buy the news, sell the, buy the rumor, sell the news um, formation. However, some journalists noted that the market was expecting the RBNZ to have a hiking bias, with some expecting a rate hike as early as this year. So it turns out, though, that the RBNZ wants to keep their OCR ready, steady for a long while. So that was one of the reasons why. So people were expecting, even though it's going to keep the rates unchanged, there are going to be hints about a rate hike, but they did not. So the market was a bit ahead of itself, right? And Wheeler, RBNZ governor, also mentioned that. And not only that, the RBNZ's own projections showed that a rate hike can only be expected by late, now hear this, 2019. That's 2 years from now at the earliest, which is way later than what the market has already priced in. So that was a little bit of a downside because the market had been heavily betting that the RBNZ would have a more hawkish tune while signaling a future rate hike in the near future, but their neutral bias kind of took the market participants off guard. So that was the reason why Kiwi kind of dropped 2 weeks ago. But now we're seeing a little bit more. We're going to get into technical analysis and show you exactly what's going on. So besides the economic data, and okay, let's actually take a look at the economic data as well besides the rate hike. So these three, tourism, rising commodity prices, fintech, these are very long-term outlook on the New Zealand economy. Now let's see what has been going on, what else has been going on in New Zealand economy. Let's do a filter change and see in the short term, let's say from last January, not last January, from January until, let's see what we have later coming on. I'm going to the economic calendar and selecting New Zealand over here. All right. And we're gonna, where is at the filter? Okay, filter results. So besides the RBNZ rate decision, we had some other unemployment rate, for example, which came in worse than expected and worse than the previous quarter. We had consumer price index, so this one makes sense, right? Consumer price index that ticked much higher, but this one is back in January. This is last month, right? And other than that, we are now expecting, so the global dairy products were something that was a little bit in a negative territory. So besides commodities, New Zealand also relies on dairies such as milk, cheese, and butter because they have a ton of cows there. So this index is also important to keep an eye on because you want to know if the better this index is, better for the economy. So these are the stuff that we see in the economic calendar. But as I said also in the previous webinar, recently you shouldn't really, because of the political environment, in international environment, it is very important not to only rely on the economic calendar. You want to really dig more into what is going on in terms of long-term economic outlook, right? So with that, we are now going to, as I said, I wanted to just briefly touch upon what's going on in the U.S. as well. I've written global here, but I really want to talk about the U.S. because that does have, has proven to have a ton of impact on international community as well. So you know, the new president of the U.S. is Mr. Trump. And there has been a ton of uncertainty going on regarding his plans. But first, yesterday we had the FOMC meeting minutes. And that was interesting because even though, so here are some takeaways from the FOMC meeting minutes, which was for February. So they revealed that many participants expressed the view that it might be appropriate to raise the interest rates again fairly soon. So yesterday, all over the news, we were seeing this keyword, fairly soon, fairly soon. However, it came with a caveat. Specifically, a rate hike is only warranted if incoming information on the labor market and inflation was in line with or stronger than their current expectations, or if the risks of overshooting the committee's maximum employment and inflation objectives increased. So here, like they were really vague. So he said fairly soon, but if this and that and that and that and that happened. And we all know, so that was basically one of the reasons why, besides the fact that the markets was buying the rumor, and then once the news came out, they just sold it, which is a very fairly general fact. Other than that, this was one of the reasons, this quote from the minutes was one of the reasons that was viewed as a caveat. So as I said, so we have a ton of, and the Fed has a ton of uncertainty related to fiscal policy. And they think that near-term risks to the economic outlook appeared roughly balanced. However, they said that considerable uncertainty about the prospects for changes in fiscal and other government policies are worrisome, right? Hi, Melissa. Oh, long time no see. And hi, Pep. All right. I'm seeing people who are just joining us. Where were we? Okay, so we were talking about Fed a little bit, right? So the Fed officials continue to view the possibility of more expansionary fiscal policy as having increased and upside risks to their economic forecasts, although some of them noted that several potential changes in government policies could pose a downside risk, right? So if you, here I just read what they said exactly. So if I put it in simpler terms, they basically, as I said, are not certain, are worried and are uncertain on the potential effect of more fiscal stimulus under Mr. Trump. And so the Fed officials are split between those who think that it would be a good idea and those who think that it would be a bad idea. But for yesterday's meeting for February's meeting, most saw Trump's planned fiscal stimulus as a good thing for now, which is interesting. And a couple of participants argued that such uncertainty should not deter the committee from taking further steps in the near term to remove monetary policy accommodation, because fiscal and other policies were only some of the many factors that were likely to influence progress towards the objectives. And so these were the ones who thought it's a good idea. The other Fed officials were saying we should wait and see, and we should be cautioned against adjusting monetary policy in anticipation of policy proposals that might not be enacted, or if enacted might turn out to have different consequences for the economic activity and inflation than what they currently think, right? Another very important takeaway from the minutes was that many or several of Fed officials were concerned about the downside risks to economic activity associated with the possibility of additional appreciation of the US dollar. They didn't explain why, but it could have something to do with exports, because a stronger US dollar would make US exports relatively more expensive in other countries and less competitive. So you might ask, why is this a problem now? Hasn't the US always been exporting stuff, but a stronger US dollar seemed to be a good thing, a good sign? Well, the answer is that this is different now. Now times are different because Trump has been saying that he wants to bring manufacturing jobs back into the US. So that means right now, for example, for your iPhone that is produced and manufactured in China for a fraction of the cost, bringing back manufacturing of iPhone itself, for example, let's say an example iPhone, to the US, that would mean that instead of paying 900 US dollars for your iPhone, you would probably have to pay 3,000 US dollars. And that, if the US dollar is strong, would make the iPhone even stronger in other countries. So I'm sorry, the iPhone even more expensive in other countries, and probably that will make them less competitive with other brand names, or well, we are not going to say iPhone creators, but phone creators who might come in and produce something for a cheaper price, so the competitiveness of the US will go down. So with that, and of course a weaker economic growth, if you have less export and there is less demand for American products, that would mean that there is also no need to hike rates to stop the economy from overheating. So that could be the reason why. All right, and aside from posing a downside risk to the economic activity, several Federal Reserve officials were also concerned that a further appreciation in the dollar would result in downside risks to the inflation outlook. And the reasoning for that is that a stronger US dollar would make import of non-energy commodities relatively cheaper. Cheaper imports would then mean less inflationary pressure, and then weaker inflation would mean less urgency to control inflation by a rate hike at a faster pace. Right? So with these reasonings of the analysts, they were basically thinking that a rate hike that's fairly soon coming may not be as soon as March. And that is the reason why we saw the US dollar drop yesterday. All right, so far, for those of you who just joined us, I just wanted to touch upon with New Zealand economy. Personally, I kind of feel like comparing New Zealand economy and the U.S. New Zealand economy is kind of so tourism is one thing that we mentioned, and there are more tourists going to New Zealand, which is growing their economy. On the other hand, we've been having reports that a lot of tourists are canceling their plans to come to the U.S. because of the Trump administration travel ban that they implemented 2 to 3 weeks ago. So, and a lot of people are just outside of the U.S. There are so many angry anti-Trump non-Americans who simply just don't want to come to the U.S. while he is the president, unfortunately or fortunately. And this is, the research was just out this morning that many people have actually changed their travel plans. So with that, my personal view is that we might see, so with Kiwi we have a little bit of a mixed signal over here. So we have long-term economic growth while a rate hike may not be on the horizon. With the U.S., we have incredible economic uncertainty. However, there could be a rate hike, not in March, but sometime in 2017. So I think we can all agree that we are pretty much in the short term, at least, mixed situation with both Kiwi and US dollar. So what do we take from this? But again, in a long-term point of view, personally, I'm kind of inclining on stronger Kiwi and a weaker US dollar, which would make a very interesting pairing. So this was the fundamental stuff, the fundamental part of the IDDA approach. So next, we want to do a live technical analysis on a bunch of Kiwi crosses and see if the fundamentals match the technicals. So let's go there. I'm going to go here, and we have our Kiwi dollar. This is the monthly chart ready. So can everybody see the my chart right now? And sometimes this, I know it's blocked. And can you see the, all right, the numbers are good? Big enough? Okay, good. So everybody can see this. So this is the monthly chart. We're going to start big, and then we're going to continue zooming back in. So this is the monthly chart going back all the way to 1993. The general trend, so look at the general movement of Kiwi versus the dollar. It hit an all-time low in the year 2000. Then we had a higher low in 2008 at 0.49. Then we had a higher low in 2015 at 0.63. This is interesting, right? Because let's actually point these out. If you actually connect these higher lows, what do you get? It doesn't quite fit. We kind of go through it, but it kind of looks like an uptrend. Another way to look at this are the highs. first we had a high over here, which is actually at the current price of a Kiwi dollar back in 1996. So 0.71 was the highest, the all-time high for Kiwi. Then the next high was in 2014, which was a little bit higher. It was at, but I mean almost the same amount. So this 0.71, 72-ish was considered the high at the time. But then right before the market crash, right, Kiwi dollar hit a new high. Oops, not this one. Right, hit a new high of 0.82. Then it crashed like crazy. Then it went up, broke above this, well, new resistance or new high, and created an all-time high of 0.90. So this was the closest that the Kiwi ever got to parity versus the US dollar, where US dollar would be one Kiwi dollar. And then we had a higher high, our final and all-time high, which happened relatively recently, back in 2014, right? And then we had another crash. Broke below the Ichimoku cloud, and now it kind of looks like it's on its way back up. So what do we see from this? I don't want to have the ads here. So it kind of looks like the lows are getting higher and the highs are getting higher. This doesn't necessarily fit into a channel, but you can kind of see at least the direction. This is a Kiwi dollar is going, and if you look at the all-time highs, right now the current price is at a 1996 high. And that is why it's kind of ranging here. It's having such a difficulty breaking above it, because historically this zone between, well, 0.75 to 0.71 has been of a very significant historic importance. Back in 2010 also, the pair really struggled to cross above this level after the market crash, right? So what does this look like, by the way, to you? So in 2008, we hit an all-time high, then it crashed, then the market went back up, struggled at this point, eventually broke above it, and it created an even higher high. Then we had the higher high, consolidated for a while, then we had another crash, another low, and now it's struggling again at this point. Right? Do you see where I'm going? However, so these are all good, right? However, from an Ichimoku Kinkohyo point of view, for those of you who have read my book, the pair is still below the Ichimoku cloud. The Tenkan line is the turn line, which is in blue, and the Kijun line is the slower moving average, which is in red. And here, the Tenkan line has broken above the Kijun line. So that is also one bullish indication. Another bullish indication was this bullish engulfing. So normally you would say, okay, so why is then, if there was a bullish engulfing, which is a very significant bullish indication normally, you might ask them, why is the Kiwi dollar going down? Well, we did, technically speaking, most of the times after a massive bullish engulfing, you see a retracement if you do have enough evidence for that reversal, that would actually be a very good buy price, because you're seeing it pull back, but the overall view is to the upside, so you can buy at a lower price. However, we still have the Ichimoku cloud to overcome on a monthly basis, right? So even though the pair right now is kind of moving within this upward channel, right? I'm gonna create this upward channel right over here, right? It's kind of moving. It doesn't quite again fit the upward channel, but I mean if you do that, right? So this is our upward channel that the pair is moving inside, and our resistance is obviously, well, I would actually say that our key long-term resistance is also this high upper band of Ichimoku cloud at 0.75. So to me, especially also with all the long-term outlooks that we had on Kiwi, there is a good chance we see this pair bouncing at least one more time to 0.75 before coming up with a solution. Because as I said, New Zealand economic outlook, only from an economic point of view, not from a data point of view, it kind of looks promising, while the U.S. is an uncertainty. So that was a monthly view. All right. Now we're going to get into the daily chart. Ooh, look at that. So with the daily chart, again, we have very interesting formations. First and foremost, we have the break above the Ichimoku cloud, which happened here. Make sure I'm recording this, by the way. Okay. So we had the break above the Ichimoku cloud. Here, though, we have the Tenkan line breaking below the Kijun line, so that is a little bit alarming. But so that is a little bit uncertain over here. However, we have this. Can everybody see this? This double bottom formation could be, right? So this could be a double bottom formation with the bottoms right over here at 0.71. Right now, the pair is testing this neckline of 0.72. And since this is a neckline, this is going to be a pivot point. So that is interesting. If we confirm tomorrow, if it confirms above this neckline, that will at least mean that from a medium term, we could see a little bit of a rise here with Kiwi dollar up to our resistance, our medium-term resistance of 0.7321. So a trading strategy for medium to long-term traders here. There are several ways. Again, we always go based on your risk tolerance. We really want you to not rely on one trading strategy. It's not a one-size-fits-all. It depends how much risk tolerance you have, what other open positions you have, how you're hedging, all that kind of stuff. So with that, I'm gonna kind of identify different scenarios for people with different risk appetites and risk tolerances. So I'm just going to briefly oops, no. I am going to delete this channel so that we are not confused. And then I'm gonna use our Fibonacci retracement levels. First I'm gonna do our longest, most recent, and see where we fall. So with everything that we just found out, this doesn't really fit well. Let's see. This one is closer to the pivot that we're looking at. So this is how I confirm which Fibonacci retracement could be more reliable, right? So this is the most recent and the strongest uptrend, right? Because here we kind of had a stall and then restarted again. And what we can see is that the 23% Fibonacci over here is kind of close to our neckline that we just identified. So this zone between 0.72, well, 0.7235 and 0.7214 is our pivot zone, right? So I'm just going to put it right in the between. So one thing I want to remind you is that these support, resistance, and pivot levels are never a specific price. It's always a zone, especially on a longer term time frames. All right. For example here, right, I'm going to bring this a little bit lower. 0.75. You see, didn't quite reach 0.75. So next we have the 38%, which completely, it's very well driven, right? So this is not only 38% Fibonacci retracement level, but also, all right, I just got no sound comments. Is the sound back? Can everybody hear me now? Okay, awesome. So we're going to go back to Fibonacci, right? So this Fibonacci retracement level, this is 38%, falls perfectly on the previous resistance, previous support. So you can see that this 0.70 is a very, very important level, medium to long-term support level, which also falls below the Ichimoku cloud. Then we have the strongest of them all, which is the 50% Fibonacci retracement level. And if this one also falls, it's not as significant. So here, I mean, it hasn't quite reached this resistance over here. But actually, I quite like it because it's a little bit above this bottom here, which makes it a little bit less risky. So these are our support in purple, pivot in orange, and for resistance, I'm actually going to just bring this down so that you're not very high in risk appetite. And then I'm going to create one very long-term resistance level based on the top over here. I'm going to go a little bit below that just to be safe. So we have two resistance, two pivots, and two support levels. Okay? So with that, what is a trading strategy? Let's start with a higher risk. A higher risk is that looking at the overall growth, and because this is the neckline and we still don't have the confirmation, okay, I'm not going to talk about the higher risk because I never like this. We're going to go with medium risk. So I would wait for a confirmation of a break above this pivot level and then wait for a pullback. Because I want the confirmation, but then normally, because so far we've had two very strong candlesticks, bullish candlesticks, right? So there is a very good chance that tomorrow after you see this confirmation, and if it does confirm above the Ichimoku cloud, you're going to see a little bit of a pullback intraday, right? So that is when you're going to go ahead and set a buy limit order for Kiwi dollar at this level, 0.7220-ish, right? It doesn't have to be an exact number. At the time, you can like really look at the market sentiment and see if it's going to reach that or not. You can have it a little bit higher up. And so your first stop, if you're conservative, would be 0.7321. And if you want to take higher risk, it would be 0.7447. So as I said, so far, and if you want to take lower risk, we can always see this level supporting, being very strong, and not letting the pair confirm like tomorrow. We could see another bounce back actually down towards the Ichimoku cloud. And then we have the Ichimoku spans as our support levels. So then I would actually wait. If you have lower risk appetite or risk tolerance, I would wait and see if it doesn't break above it. I would wait to see if any of these levels will hold. I wouldn't go below Ichimoku, right? If it crosses below the Ichimoku cloud, then our outlook will change. But if the Ichimoku cloud holds, and here as you can see our Ichimoku cloud is kind of upward, if any of these levels hold, then I would actually set to buy here. Another thing you can do, if you do end up buying tomorrow at this level and the market retraces back, pulls back, you would continue buying as it drops instead of having a stop loss, right? So you add to your position, and that is why it's very important not to have high leverage or high margin, because then you will not be able to add on to your position. You would have to get out. But if you start with a smaller amount, then you can see how the markets behave and readjust, and you can buy more as it drops. And if it drops, and lower your net long, and then again target to get out at 0.7321 for now, or 0.7447 for a long run. Of course, these can change. So this is what I see today, and well, in a week time, things could very, very well change. So that is why you always want to be informed, or if you kind of don't want to care about it at all, you can just let it run. If you are low on leverage, you can let it run for 6 months until you actually get out. Because with the Forex market, the beauty of it is that it always ranges. And right now we can see, so the reason why I have, by the way, I prefer 0.7321 as our target for now, is because even though we had this strong uptrend, now the highs are kind of lowering down from a medium term. You know how we did it for the monthly chart, that the highs were going up. From a shorter term point of view, the highs are going lower. So what I would be cautious of is that if this trend kind of follows and the next high wouldn't even reach here. So that is when if you are a little bit cautious of that and you don't want to take much risk, a lower risk approach would be targeting a little bit lower than this high to give room for the possibility of this kind of downward high trend that we're seeing. That is for really low risk traders. All right, so that was Kiwi dollar for us. Do we have any questions so far? Okay, we're getting questions. Forming, oh, hold on. Okay, so I'm getting a question from Ken. Is that a possible right shoulder forming on a reverse head and shoulders? Which one are you talking about? Are you talking about here, upside down, head and shoulder? Or are you talking, yeah, okay. Yeah, this could be very well, but I mean, so as you can see, so this could, you're talking about, this is the first shoulder, this is the head, and this is the upper shoulder, right? The only problem is that, I mean, yeah, you could definitely say that, which is, again, that backs up our bullish observation. However, a head and shoulder is a real, is a good indication, a bullish reversal indication, if it happens within a downtrend. So you can argue that this is the downtrend, but so for that head and shoulder, the neckline of the head and shoulder would be this, right? The headline, the neckline would be, if you connect these two, right? So this would be the neckline of that head and shoulder, of the reverse head and shoulder. And it didn't really start on a downtrend. It started on a consolidation. And for that, so, but I mean, for that to be a strong indication, that would be ideal if it occurred within or during a downtrend. But yet again, a head and shoulder with an angled neckline is always a very strong bullish indication. So with that, after you've reached, if we actually do see this as a head and shoulder, and we definitely do have other bullish indications in place. So the connection of that would make, if you see that as a bullish signal, you could be more confident in 0.73 as your bullish target, or even higher, right? And if this, then this angled neckline would be your resistance. And if it does break above it, then our long-term outlook, right? We have a lot of our long-term outlook. Then here, well, our 0.75, right, is our long-term, and by then it probably has even broken above the Ichimoku cloud, which brings us to the next trading strategies and longer term, because if it does break above the Ichimoku cloud, then we're going to get into cloud 9, right? Then our targets are going to come as high as 0.80, but we're not there yet. And of course, under this political uncertainty and climate, I would have my targets a little bit smaller. Normally, I'm a very long-term trader. For those of you who've been with me for years, you know that I just stay in a trade for years. But recently, I'm trying to set my targets a little bit smaller. Still long-term, but I'm targeting smaller targets because we basically really do not know what's going to happen to the world, literally, in the next year. So there is just so much that you can predict, and as all of you know, past performance doesn't indicate future results, right? So I want to also, so we're all good with Kiwi dollar. I'm going to go ahead and take a look at Kiwi yen, which is another cool currency to take a look at. And I think we did this last week, maybe, or no, we've done a ton of Kiwis. So I'm gonna go ahead and let's start fresh. I'm just going to delete everything. This one is good. I'm gonna keep that. This one is also good. So again, going from monthly, we already have the arrows here. We have this double top kind of. So with Kiwi yen, it's a little bit of a different scenario. As we said, if the US dollar really does start getting weaker, that would only mean the Japanese yen could get stronger. So that would make a Kiwi yen combination a little bit less desirable than Kiwi dollar, because you normally want to pair a strong currency versus a weak currency. But if both Kiwi and yen are strong, there will be a ton of struggle, right? There will be not much of a trend, which we actually can see it here. The pair is literally inside the Ichimoku cloud, which, as you know, is a consolidation indication. And so for me, for Kiwi dollar, for Kiwi yen to break out of this Ichimoku cloud and reach once again these highs of the 90s is a little bit less certain than that of Kiwi dollar. But still, I mean, obviously it's not going to be impossible, but we have, at least from the monthly point of view, we certainly have this barrier. So even if Kiwi gets strong and then yen gets strong, they're just going to struggle and bounce between the 75 and 82 at the minimum. So because we don't have really any indication here, we did have this bullish engulfing, but then it wasn't able to break above the Ichimoku cloud on the monthly point of view. So from a very long term, we really don't know anything about Kiwi yen. Let's see if we can say anything on a daily point of view. From a daily point of view also, we already reached So that was that bullish engulfing, right? So that was month of, that was these 2 months, right? It broke above the HTML cloud, reached a ton of our, actually I think with Investiva Group we did trade this, right? And reached our targets. And now it kind of hit this resistance level. It's forming, in my view, this could very well be a double top, right? All right, not that. We're going to create our resistance right at the double top over here. So this could very well be a double top. It's now consolidating within the Ichimoku cloud. And this is our resistance. So I am going to bring this down. This is our new pivot. All right. And so again, from a daily point of view, we really don't have any cues. So even if this is a double top, all right, let me see if I can see something else and what levels we should be looking at. So this is good, right? So this kind of confirms the 23% right falls right in the zone of the double top's neckline. So this is our most important level that you want to look at from a daily point of view with Kiwi Yen is the 80 to 81 zone. So this is our pivot. And next we have the Ichimoku cloud, right? So for me, for Kiwi dollar, here are 2 scenarios, right? If it bounces off the 23% and breaks above the Ichimoku cloud once again, I would consider a short-term trade towards this 83 level, but a little bit lower, because it might not reach all the way to the high, right? So I would target like 82.90 or something if it does break above the Ichimoku cloud, and I will just call it a day. Then, sorry, if it is not able, if it is able to break below this pivot in 23% Fibonacci and Ichimoku cloud, right? So by the time it reaches here, because right now it's kind of going up and we have a spinning top, so it is likely that by the time it reaches this pivot, it also will break below the Ichimoku cloud. That would be a significant bearish signal, technically speaking, right? And for that, this would be the levels I would take profit. So if it does confirm below the Ichimoku cloud and the 23% Fibonacci, your lowest risk target would be the 38% Fibonacci at 79.29. And if you want to take a little bit more risk, you would go with 50%. And I would not go below that. So these are, in case this is a bearish scenario, if it breaks below it, you wait for a correction, because when it breaks, it kind of goes back again. So you sell high, and then you take profit at one of these levels. I wouldn't really go to here for now because of all the uncertainties. All right. So do we have any questions when it comes to Kiwi Yen? All right, I'm getting no, it's all cool. No. All right. Okay. All right. So with that, I think we covered a ton about Kiwi, from the economy to trading strategies and everything. And if you don't have any other questions, I would just go ahead and end the webinar for today. If you do have any questions, I'm here for you and I will answer any other questions that you might have. It's been lovely. Thank you. I'm getting a lot of thanks you. Thanks. See you tomorrow. See you tomorrow too. Okay. All right. Okay, great everyone. Thank you so much for joining us. If you have any questions after the webinar, you can contact orbitz.com, and hopefully I'll see you soon again.